Hey everybody, so we're going to talk about S&P 500 index funds and just index fund investing in general. Before we do, please click subscribe to my channel and take a minute to look at the link on your screen for a message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So, index fund investing in general. An index fund is an instrument that's basically designed to do what it sounds like. It replicates the performance of a certain index over time. For example, a S&P 500 index fund would try to match the performance of the S&P 500 over the years. The way it does that is it pools investors' money together and invests in the stocks of all 500 components of the index. So the performance of the S&P over time has been very good. It hasn't been, the 20%, 30% growth rates that you've seen in certain stocks in the past few years, but it's a generally steady, good performer over time. So that's the general reason for investing in an S&P 500 index fund. It essentially puts your investment strategy on autopilot. You don't have to do any homework. You're going to match the index's performance over time. You won't beat the market, but the other way of thinking about it is you won't underperform the market either. Since 1965, the S&P 500 has produced an annualized return of just under 10%. That's a pretty stellar record of performance over such a long period of time, and you'll see kind of context of what that means to long-term investors in a little bit. And most S&P 500 index funds, as compared to say an actively managed mutual fund, can do this for very, very little cost to you. We'll get into the fees that these index funds charge in a bit, but they are very, very inexpensive ways to invest automatically. The other big question when you're looking at index funds is, should you buy an exchange traded fund ETF or a mutual fund? I don't really want to go too deep into weeds with this, but for most investors, an ETF is the way to go. ETFs, one, they don't have minimum investment requirements. A lot of mutual funds require you to invest $500, $1,000, or even more to get started. With an ETF, you have to buy just one share of it. It trades just like a stock on a stock exchange. Um, and depending on who your broker is, some brokers these days offer fractional shares. You could buy ETFs with as little as $1 in a lot of cases. ETFs are commission free at all major brokers. That's not true for all mutual funds, especially when it comes to the low cost index funds like the ones we're going to talk about. So I generally recommend investors to stick with ETFs. There are mutual funds that invest in the S&P 500 too, and there are some good reasons to invest in those. For example, if you have a 401k at work, they are generally mutual fund based investment accounts, not ETF based. So when it comes to ETFs, and these generally have mutual fund counterparts that are offered by the same companies, there are three big ones when it comes to S&P 500 index funds. Number one, you have the Vanguard S&P 500 ETF. Vanguard pioneered the concept of the low-cost index fund decades ago and is still one of the leaders in the space. You can buy this just on the regular stock exchange. Ticker symbol is VOO. It's about $364 per share as I'm recording this. I don't know what it'll be at the time when you're seeing this, but it should be in that ballpark. And it has, talking about the fees we mentioned earlier, it has an expense ratio of 0.03%. An expense ratio, the short version is that is the fees you're paying to invest in a ETF or mutual fund expressed on an annual basis. And what that 0.03% means is for every $10,000 you have invested in this fund, your investment expenses are going to be just $3 a year. So as the index goes up over time, you get to keep most of your gains. It doesn't go to pay some kind of active mutual fund or hedge fund manager or anything like that. So the Vanguard one is number one. One that's almost an identical product is the iShares Core S&P 500 ETF. Ticker symbol is IVV. It has the same 0.03% expense ratio, roughly the same share price. And these share prices aren't necessarily going to be forever. ETFs can and do split their shares over time, just like regular stocks. So that's always a possibility. But if those share prices are scaring you off, like you don't want to invest $400 every time, check out or look into a brokerage account with a broker that allows fractional share investing. And third, last but certainly not least, is the largest S&P 500 ETF. That's the SPDR S&P 500 ETF Trust. Ticker symbol is SPY. It has a slightly higher expense ratio from the other two, but that's still pretty low as far as ETFs and mutual funds go. The typical actively managed mutual fund has an expense ratio of roughly 1%. So this is much, much lower. Again, roughly $400 a share. And I mentioned this is the largest one in the group. I personally prefer one of the two less expensive ones, but no discussion of S&P 500 ETFs is complete without naming the largest one. Now, there are others, but these are the three largest by far in the entire market. So the question that's probably on everyone's mind, can an S&P 500 ETF make you $1 million or more? Now, I mentioned that the index has returned an annualized average of about roughly 10% per year since 1965. Now, while that's a pretty steady track record and a pretty long period of time, that past performance doesn't necessarily guarantee future investment results. But having said that, just using that as a benchmark, a $500 a month investment in an S&P 500 index fund would reach $1 million in just over 30 years, roughly 30 and a half years. So you would cross over that $1 million, assuming a 9.9% annualized compounding rate. After 40 years, it would be worth $2.6 million. So the short answer is yes. If you invest consistently over time in an S&P 500 index fund, you can retire a millionaire just on that. Now, I love investing in individual stocks. Pretty much everyone who watches my channel knows that. But there's absolutely no harm if you don't have the time, the knowledge, or the desire to pick individual stocks. There's absolutely nothing wrong with putting your investments on autopilot because you can create tremendous wealth over time if you're consistent and disciplined with it. Hopefully, you enjoyed that. Please, I would love to hear any questions or thoughts you have in the comments. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.